All right, well, thanks. I'm going to share a scenario with you. An agent attends a webinar about the importance of disability insurance. He gets this light goes off in his head, and he gets this idea that he should reach out to everybody about income protection. And the very first client that he calls agrees to meet with him. Now, he paid attention during the training, and he made sure to ask about the occupation and income so that he could have a quote. So the day of the meeting, everything's going good. Reestablishes the need, shows him the proposal, and the client agrees to move forward. The agents start to think, you know what, this DI stuff is pretty easy. But they get to the application, start asking health questions, and all of a sudden some health conditions come up. Now, the agent isn't sure whether or not the client's going to qualify, so he decides to continue with the application. Goes ahead, submits it to the carrier. A month later, it comes back a decline, right? Now the agent reaches out to a Plus Group member, says, hey, I had this client, he was declined, what else do you got? Plus Group member says, well, there's this new Flex DI from a carrier called Risk. They take impaired conditions, but there's two things you need to know. Number one, the benefit's going to be graded the first 2 years, and number two, it's going to be a little bit more expensive than the original quote that you showed them, but obviously your client has a health condition, so that makes sense. Agent says, great. So he emails the quote, the agent gets it, immediately goes down to the price, and now he hesitates, right? It's more than what he originally showed him. He doesn't know if the client's going to go for this. So what does he do? Maybe nothing, maybe emails it to him. If he's a good agent, he's going to sell that policy based on value and not price. And if you go out and if you Google value versus price, you're probably going to see some quotes from Benjamin Graham and Warren Buffett. And they're going to say price is what you pay, value is what you get. Now, obviously, they're referring to buying stocks and businesses, but the question that I ask is, can the same concept of selling based on value be applied to insurance, and specifically an impaired risk product? And obviously, I think the answer to that question is yes, but I'm going to share an example of what I consider the most commoditized insurance sale out there from my previous role at a major medical health insurance carrier. So we sold ACA plans, and my job was to go out to the agents that sold these plans and convince them to sell ancillary products, right? Life insurance, disability insurance, maybe a critical illness, accident plan. But here's how that ACA sale went. First of all, the government does a great job marketing. You can go out to the healthcare.gov, and it'll say that 4 out of 5 insurers pays less than $10 a month. So when that that client calls up that agent for health insurance, how much do you think they're expected to pay? 0, right? And so the way that sell goes for 85% of the agents out there is they type in their information into the program. It shows them the cost. They go to the lowest premium plan, which is sometimes 0 premium, and that's what they sell them, right? Now that's 85%. I'd go to them and I say, hey, why aren't we selling these other products? Obviously, you saved them $500 with the subsidies. You could apply some of this to the other products. And they say, well, these clients don't. They want the lowest cost insurance. Now, what about the other 15%? So the other 15% would average 2.5 policies per insured. And so I would ask them, I said, hey, what are you doing? You're averaging 2.5 ancillary products. This guy is saying that these clients don't want to buy it. It's the same demographic, same income, same area. What's going on? And that agent said, hey, I'm selling on value. That guy sells on price. And I said, go on, tell me more. And he said that he only focused on the cost of insurance. I focus on the cost of insurance, but I also talk about the cost of receiving care. And I say, well, how do you establish that in the sales meeting? And he says, I just ask a series of questions to determine what that client needs, and then I show them the solution that meets those needs. Amazing, right? And so I put together a couple of questions to ask a client to go before you meet with them about a graded impaired risk DI plan that will help establish the value and not focus solely on the price. So before I get into it, I want to share just a real quick case study. And this is a quote that came in. Individual had Hodgkin's lymphoma. The original quote request was 90-day elimination, 10-year benefit, 60% of income. And when we looked at the price tag on it, it was pretty pricey. And what we told this agent before they went out and met with this client is we said, well, first of all, don't focus on the price right now. I'm going to give you a series of questions to ask this client. Make sure you get buy-in that when you're designing a plan that it includes all of these, and then talk to them about the price. And if they don't like the original price, have a plan B, which this is what we sent them for a plan B, where we lowered the monthly income, extended the benefit, or lowered the benefit to 7 years, extended the elimination period. But we said before you show either of these plans, make sure that you show them the value. Now, obviously, the big thing, the value on this individual was had been symptom-free for 3 years, and so we were actually able to exclude the Hodgkin's lymphoma, and so that's the value. But here's the questions that, we recommended him ask. First of all, do you want it to cover your conditions? Now, this bullet point makes our underwriters really nervous. I'm supposed to point out that those commas are ors, they are not ands. So the key of when we can cover or when we cannot exclude is going to be based on single morbidity. But it's not uncommon for us to be able to not exclude diabetes, cancer, and heart attacks and things of that nature. And so when you talk about value, that's going to be the biggest thing that's going to apply to or appeal to the client. The second one is I always like to ask, do you want this to cover you for your working years without having to reapply for coverage, right? And that's where the guaranteed renewability comes in, where this plan, once they get in force, they don't have to reapply every 3 or 5 years. It's going to stay in force. And so that's going to be huge. Obviously, talk about covering your craft, and that's where the own occupation definition comes in. Now, it is an impaired risk, so built into the plan, we only can do 2 years, but if the client wants to extend it, we can do that with an owner-occ rider as well. And then the final bullet point is, do you want it to cover crazy, right? I always think, has anyone here ever seen Better Call Saul, right? And you think about the brother, right, that kind of lost it. A lot of these high-income earners, they're under a lot of stress, and it's not uncommon for them to have a mental nervous disorder. So it's nice to have that built into the plan as well. And then a couple other questions to ask is, do you want longer benefit periods, right? Probably this oral surgeon was originally shown a 2 age 65 benefit. Now, we're impaired risk, so we can't do 2 age 65, but we can get a 10-year benefit or a 7-year, so we have that flexibility. Also, do you want a benefit to reset, or do you want it to be one and done? What I mean is that if you go out on claim and then you go back to work for 6 months, do you want to be eligible for that benefit? Well, yeah, sure, I want to be eligible for that benefit. And then finally, do you want a benefit that pays partial? So if you're disabled, you go on claim, you go back part-time, do you want your benefit to stop, or do you want to receive a partial benefit since you're not back full-time? Well, yeah, I want a partial. If you ask those 7 questions and the client says, yes, I want all to them, the answer is going to be FlexDI. And so the key to selling this plan is to focus on value before you focus on price. We're always asked kind of where our fit is as far as occupation classes. And, I'm going to be frank that, we want the high income executive, right? I think that most of the carriers do. One of the new things we did with this plan to be more competitive in that marketplace is that we do offer the 5A occupation class, so we can get pretty aggressive with the rates in that particular occupations. Also, on the medical fields, our underwriters actually have flexibility to either offer a 3A or a 4A, depending on what that risk is. And so for, maybe an optometrist, pulmonologist, lung doctor, you might be able to get that 4A, which will help with the risk. What always gets people excited is kind of down here with the business owners and specialty niches. We do insure the entertainers, we insure the athletes, artists, authors, tattoo artists, so we can kind of cover some of those occupations that maybe some of our competitors won't. Talking about singer-songwriters, here's actually someone we quoted from right here in Nashville. She's kind of starting to make it, right? She's making $150,000 a year. She's worked very hard to get where she's at in the music industry. If something happens to her and she's no longer able to boot, scoot, and boogie, does she want to find a different occupation, or does she want to receive some disability benefit? And so we were able to insure her when other carriers wouldn't. As far as financial niches, when you look at some of the 1A, 2A occupations that have income limitations on them, we're able to offer a higher benefit amount. So as long as their income justifies it, we don't have caps. They'd be eligible for the full $25,000. So, if you know any chiropractors out there making, $300,000, we'd be able to get them the higher benefits because we don't put limits on it. And then as far as passive income, obviously we don't insure it, but we don't take it into consideration in the calculation. So if somebody's making $100,000, on their W-2, we'd still insure them for the full 60%. We wouldn't offset it for any passive income that comes in. So here's just a quick example of a farmer. I grew up on a farm in southeast Nebraska, and I understand, what the risk is on these farms. My dad is 72 years old, and last year he was up on our roof replacing the roof, right? So these guys, they're working, they're doing things that aren't ideal, and a lot of them don't have disability insurance. Nice thing with risk, now I know the challenge always is that they don't like to show income, but if they do show some income, we can get them the higher benefit amounts with graded DI. So with that, now what? Risk DI, we're always going to be a subset of the disability insurance that you sell, right? And so talk to more of your clients about disability insurance, and then maybe 1 out of 10, 2 out of 10 might have some health issues, and Flex DI is going to be a good fit. Always tell agents, be curious, right? When that health condition comes up, don't automatically jump to conclusions saying my client's not going to qualify. Bounce it off and see if we would be able to take it. We can't take everything, but you would be surprised about what we can. And then finally, remember, sell on value, don't sell on price. Ask those 7 questions before you get to the quote, reestablish the need, and you're going to be able to place a lot of these impaired risk DI cases. So if you have any quotes, go ahead and fire them off. My name's Seth Groff with Risk. I'm joined here with Amy, and I look forward to talking with you all throughout this event.